So I'm aware that last time I did this a year ago, I spoke about non-disclosure agreements, and I noticed about 3 people that fell asleep during the presentation when we had a lot of text on the board with the NDAs. My goal today is 7. I'll be counting. I want to thank Jake for leading into the topic really well. He talked about some of the challenges associated with raising money at an early stage, and that is my topic. There we go. So before we get into what a safe is, traditionally, historically, there were a few different mechanisms that early stage companies used to raise money. You got a priced round and a convertible note. There were significant downsides to each of those, and there still are. These are still used very frequently, and I want to just summarize those here. With a priced round, it can be really tricky to estimate the value of an early stage company because you may not have revenue, there may not be enough data points to really land on a mutually agreeable valuation. You always, if you value it too high early, you risk raising at a down round earlier, at a later round at a lower valuation, which is a huge red flag and could be like a death knell for an early stage company. There are a lot of negotiating points to arrive at and to discuss with your investors, lots of costs, attorney fees, administrative costs. It can take a lot of time to execute one of these rounds, and it can cause the founders to take the ball off of what they really want to be focused on, which is growing their company. A convertible note has some of the same problems, but it introduces the debt aspect, where an early stage company might have to put up some of its valuable assets as collateral to secure the note. There will be a maturity date and the stress involved in paying off the note before the maturity date. And if you're not able to do it by then you might have to renegotiate the note, additional costs, additional time. And there's interest, obviously. So significant downsides. And Y Combinator, the accelerator in Silicon Valley, in 2013, they developed the SAFE, the Simple Agreement for Future Equity. The intention was to resolve some of those problems. SAFE, and by the way, I'm an attorney, so I'm going to issue a disclaimer. I'm not trying to endorse the SAFE as always the best way to raise money for an early stage company. There are lots of options. Discuss with your lawyer. But it does do a good job of solving some of these things as long as the founders don't take their eye off the ball and realize that you still need to understand how the SAFE works, how the SAFE is going to convert, and how it's going to affect your ownership in the company. So it's a convertible security. You receive the money now, and you give the equity later. The plus there is that you don't give up any control. You're not giving up voting rights immediately in the company. There's no debt aspect to it, so you don't have to pay interest. You don't have to pay a loan back. And it's really a form that you can download from Y Combinator's website. You get the form, and there are like 3 blanks that you fill in and that you have to negotiate with your investor. You've got the investment amount, what the valuation cap is, if any, what the discount is, and then you sign it. You receive the money, and you're just really happy as a founder. You move forward with running your business. That can be problematic, though. It's so simple that founders are tempted to overlook the actual terms and how those safes will convert eventually, and how that will affect the founder's ownership in the company. And I want to focus on some of that today, too, so that none of you fall into the trap of willy-nilly downloading a form, signing it, signing away huge portions of your company without tracking it. So let's look at just a quick example of how the SAFE would work. And there are several different kinds of a SAFE. You have a SAFE that has a valuation cap and a discount. You can have a SAFE that is just a valuation cap or just a discount, and a few other kinds too that are used less frequently. So let's take an example here. You have a SAFE with a $10 million valuation cap and a 10% discount. In the first scenario, the company valuation is growing at the time of the priced round when an investor comes in and the investor and the company negotiate, and they both agree, okay, this company is worth $20 million. The SAFE investors, their shares convert at the time of that price round at most likely at the $10 million valuation cap. So they're going to get a good deal. They're converting at a lower cap because they put their money in earlier. It makes sense. In scenario 2, the company valuation at the price round is only $5 million. You might think that that could be a really bad deal for the investors with the $10 million valuation cap, but in that instance, the safe holders would convert at the 10% discount from the $5 million valuation. So they're still getting the benefit of having put their money in earlier, even though the valuation is lower than the company and the investors were hoping and anticipating at the time they signed the safe. So before we move into what exactly the safe consists of, there's one more important thing that I think founders should take into account more often than they do. There are two different kinds of valuation caps in a safe. Initially in 2013, Y Combinator's safe was a pre-money valuation cap. Problem with that was that the safe holders, they dilute each other and the founders at the time of the price round. It's really hard to predict the ownership at the time of the price round. You issue the safes, neither the investors nor the company is going to know very precisely how much of the company they have sold or owned, respectively. So in 2018, I think it was 2018, Y Combinator published its post-money valuation cap, intending, among other things, to resolve that concern. With the post-money valuation cap, it's easy to know how much ownership you've sold in the company and how much as an investor you've bought, because it's a post-money valuation cap. The concern for the founders and the risk is that the post-money valuation cap, the safes, only dilute the founders. They do not dilute each other. Their ownership in the company is going to be locked in. And as a founder of an early stage company, you really need to track that, because if you issue a multiple series of post-money valuation cap safes, you could end up selling more of the company than you anticipated. Fortunately, there are ways to track that, but if there's one takeaway from this presentation, it will be please track your safes. Keep track of how much dilution you as a founder are going to experience as you issue each safe. Carta, our preferred partner, has a great service. Among the other things that they provide is a free safe calculator. You can put in different scenarios. If I sell this safe at this cap, at this discount, and I raise my price round at a $10 million valuation or whatever it may be, you can know how much of the company you've sold, and you can track that. So I highly recommend that. Because what a founder doesn't want is for its safes to convert, and they have the unpleasant surprise to realize that I own way less of my company than I thought I would, because I wasn't keeping track of the dilutive impact that these safes would have eventually. I know that one reason that founders, they love the safe because you can just download it and you fill in 3 things. Even Y Combinator, I think, has said in the past that they've promoted the safe as an instrument that doesn't require any attorney time. It doesn't require attorney review. And that may be true, but I don't understand. Who are these people who are trying to avoid time with attorneys? I don't get that. We're just trying to help. So whether it's your attorney, whether it's someone on your team, or whether it's a mentor, you need to have someone on your team or some advisor who is helping you understand the mechanisms of a safe conversion so that you track your equity and track the dilution. So this is just the introductory portion of the safe. That first paragraph just includes the name of the investor. You fill in the blank for the amount that the investor is going to put in. There's the effective date. This second sentence here, I don't have a pointer, I guess, but that's a new element that Y Combinator included in the post-money safe that they issued in 2018. And that's to assure you that, okay, it's been downloaded from Y Combinator, it hasn't been changed. We haven't modified it except to fill in the blanks. So that if you receive a safe from somebody and that sentence is not there, you know that something's been changed, and you need to pay close attention and find out what changed. Then there's the blank for the post-money valuation cap, and then there's the discount rate. Now, the thing to be careful of with the discount rate is there are 2 terms. There's a discount rate and the discount. What you don't want to do here is put in the discount from 100 as the discount rate, because then you might be giving your investors unintentionally a 90% or an 80% discount rather than a discount rate, which you don't want to do, obviously. So the 5 sections in the safe itself. The first section is the converting events, the things that will trigger the conversion of the SAFE into shares of stock in the company. We've been assuming, and I think most early stage companies and investors assume going into it, that the SAFEs will convert at the next price round, at the equity financing where there's a fixed valuation. But it's important to know that SAFEs will also convert if there's a liquidity event, meaning an acquisition, a merger, a change in control, an IPO. The SAFEs will be triggered by those events as well. Or if the company dissolves, if it ceases operations, if it goes into bankruptcy to pay back its creditors, that will also trigger the conversion of the SAFEs, so that protects the investors to an extent. The next section is the definitions. And these contain kind of the conversion mechanisms, a lot of the descriptions for exactly how it works, that the SAFE converts into shares of preferred stock in the company. It has terms like change of control, the company capitalization, and the SAFE price, which we'll talk a little bit more on the next slide. The SAFE price, the price that the SAFE holders are going to pay, they're going to have paid for their shares at the time of conversion with the valuation cap. This is where the definitions become really relevant to the dilution impact. In a pre-money SAFE, the definition of company capitalization excludes convertible securities and the SAFE. So that means, and in the post-money SAFE, company capitalization includes convertible SAFEs, convertible notes, and SAFEs. That means obviously that with post-money SAFEs, that denominator is going to be higher generally, meaning that the SAFE price will be lower, and that's where the additional dilution to the founders comes from, because this post-money SAFE investors are going to be getting a lower price. So that's just kind of details to kind of understand why the post-money SAFE adds some extra dilution. The more convertible securities you have, the more that dilution impact will come to pass. Those two sections really contain the meat of the SAFE. If you understand those things, you'll be confident when you raise money with the SAFE. And it's really not very long. Those sections are 2.5 pages, depending on the type of the SAFE that you've chosen. Anybody can read that. It's fairly simple. But I don't want to encourage you to forego a meeting with your lawyer, who's undoubtedly one of your favorite people. So make sure that you understand it, whether it's with your lawyer or with somebody else. The third section is company representations. Pretty standard stuff. The company represents that it's duly organized, that it has the authority to issue and execute the SAFE. And this third one shows you that these SAFEs are set up really for tech companies, fast growth tech companies. They represent that they own the requisite IP to run their company. Investors similarly represent that they have the legal authority to enter into the SAFE, and they have the capacity to do it. They also represent that they're an accredited investor, which is important protection to the company. It allows the company to be exempt from SEC registration in most cases. And then finally, section 5 is a miscellaneous section. Miscellaneous doesn't mean it's not important, but it probably just means that you've seen this kind of language in lots of different legal agreements. They include things like, what's the procedure for amending the SAFE? The post-money valuation cap SAFE allows for SAFE holders, before their SAFEs have converted, to receive dividends if the company issues dividends to its shareholders. The pre-money SAFE doesn't include that. And finally, among other things, the miscellaneous section will include the governing law that's going to govern the agreement. So the big takeaway here, which I think I've emphasized adequately, don't just assume that it's so simple that you can just download it, fill it out, get the money, and run, and keep running your company. Be aware that those SAFEs are going to convert at some point. They're going to dilute the founder. Whichever kind of SAFE it is, the founder is going to be diluted. And if it's a post-money SAFE, that dilutive impact can be even greater, because the post-money SAFE holders do not dilute each other. Any questions? Happy to try to answer your questions. We have microphone runners, I think, so that the people online can hear. Thank you for waiting.
This is completely new information for me, so thank you for this. What does it mean to dilute a founder?
Good question. So the founder will typically start out with 100% of the company. They'll create a stock option pool that will eventually dilute them as they hire people and grant stock options. When they raise money and a new investor comes in, the founder will own less of the company. That's really what it is. And it's important to track that, obviously, because at some point, if you have enough dilution, you lose control, and you don't get to do whatever you want with your company anymore. Does that help? Okay, thank you.
All right, what are all the downsides to consider if you stack safes? So you raise a safe on a pre-seed, raise a safe on a seed round, and I'm also interested if one of those was post and the next is a pre-seed or pre-money.
Yeah, good question. Just remember that if you're issuing post-money safes, those safes are locked in. Their valuation, the percentage of the company that they're going to own as a post-money safe holder, it's locked in from the time they sign the safe. Because when they convert, they only dilute the founders. They do not dilute each other. Pre-money safe holders will dilute each other and the founders together. And it's the downside of the pre-money safe. Obviously, it's better from a dilution perspective for the founders. The downside is it's not predictable. It's hard to know until the actual conversion happens how much of the company the founders and the safe investors are going to own.
But does it make it more complicated if you stack two different rounds of safes?
You mean like you have pre-money safes and then post-money safes?
Post-money and then later raise on a pre-money.
So I think my answer to that would be that the compounding impact is greater with the post-money safe, because it's that denominator question. The more safes that you have in a post-money valuation cap, the bigger that denominator is going to be, and the smaller the safe price is going to be. With the pre-money safe, that denominator doesn't change with the addition of new safes, because it excludes converting securities. Does that answer?
Yeah. So basically, it doesn't complicate it if you're stacking different fundraising rounds.
No, but it's important to track it either way. It might be harder to track it, but it sounds like you're aware of it, and that's probably the most important step. Yes.
What would you say is one or two pieces of advice for getting an investor to agree to do a safe when they would rather use your small numbers and try and get more equity up front?
Good question. From an investor perspective, there are a lot of things that are appealing about getting a valuation. The challenge, as I mentioned, is just agreeing on what the company's value. Typically at the early stage, the founders see huge value in their company. The investor is going to come in and say, I don't value your company that highly because you don't have any revenue yet, or you don't have as much traction as I'd like to see. I guess if you really want to use a safe, you would point out to the investor that, look, there's a very, very low risk. You could say this would be the founder perspective. We plan to do a price round in 1.5 years. Your safe will convert then. We're going to give you a valuation cap. We anticipate that the valuation of our company is going to be 50, 100% more then than it is now. So you're going to get a great deal because you're putting the money in earlier. That might be one talking point, but there are a lot of things. Yeah. Anything else? Steve, yeah?
Are there particular types of companies that benefit more from safes in general than others?
Yeah, good question. It's set up really to benefit tech companies that are on a high, or that hope to be on a high growth trajectory, where they can set a valuation cap and confidently say that the company is going to be worth significantly more than that at the time of its next priced round. So it probably wouldn't fit very well for a lifestyle business, although I don't know that it couldn't be used for that. It's just not set up for that. It's set up for companies that Y Combinator would have been attracting.
Perfect. Thank you.